It's Sunday, October 16th, 2022. This is All About Your Benjamins and your weekly mixtape and weekend review. Hope you had a great week. Let's not waste time. Let's get straight to the headlines that may or may not be impacting your financial plan and portfolio. And if you're watching this on the blog over on All About Your Benjamins, you can see down below, we've got a number of headlines to run through. A big week when it comes to economic data and to the markets. And while I love talking about other areas of financial planning, areas that we can actually control and I think actually make a bigger impact, it is important on weeks like this where there's a lot of craziness going on that we break those down. So first and foremost, let's start with Thursday. We're going to start kind of towards the end of the week, and the inflation reading came out for September, and it was hotter than expected, and hotter not in a good way. So according to the Labor Department, it said that the core consumer price index, the core CPI, was up 6.6% in September. Now, core CPI does not include energy costs or food costs, which kind of seems crazy since those are some of our biggest expenses as consumers. So when we add those back in, the CPI, the overall CPI, was up 8.2%. So it was actually down a little bit because of gas prices, but nonetheless still at highest levels since 40 years ago, 1982, a great year, the year that I was born, but these are the highest levels since August of 1982. So this is not anything surprising to you. You understand what's going on with inflation. You see it when you go to the grocery store, when you go to the gas station. Things are getting more expensive. However, it's not being reflected quite yet. We are seeing some things come down in price. The price of homes are coming down. The price of building homes is coming down. There's other expenses out there that were at that highs that are beginning to come back down, which means that maybe we'll start to see a print of inflation that will come down, and it's going to be a lagging indicator. Nonetheless, the measurement that came out for September still puts the Federal Reserve on pace to raise another 0.75% on their inflation or on interest rates to try to combat inflation, try to get it back down to 2%. Remember, that's the goal. I heard an interesting comment on a podcast, maybe it was last week or 2 weeks ago, where maybe the Fed will accept that a 2% inflation rate is not reasonable anymore and 3% might be the goal. I don't know if that's a good thing or not. I don't know if they'll do that. If I had to guess by listening to Chairman Powell, that doesn't sound like they're willing to change from the metrics that they have deemed to be the best for the country. So 2% is the goal. We're at 8%. We got some ways to go, but nonetheless, I think that we can expect more rates to be going up in the future. I talked about this in the last video. It would be nice to see them just pause and see, hey, let's wait and see if some of these things are continuing to come down, and maybe we don't have to be so aggressive. Maybe the work is there. There's an argument in the piece in the mixtape down below by Cullen Roach that says that they've overshot on the lowering of interest rates and keeping them low, and that they're overshooting on the raising of the interest rates going through right now. We've talked about this before, but I liked his analogy to pivoting in basketball. Everybody's looking for a pivot from the Fed, meaning they're going to change their mind, and he said that they don't realize that they can't pivot because they don't know that they've turned the ball over. I thought that was a great line. So check that piece out down below in the mixtape. So inflation was the big thing. Another interesting development on Thursday around inflation was the reaction to the market. So going into the market open, the pre-market futures, the market was slated to be up. Inflation comes in hotter than expected, and the market goes down significantly, down up to almost 3% on some of the indexes. And by the end of the day, the market had reversed and went full course back up, and we finished up over 2% on all of the indexes, 2.5, 2.6, 2.8, depending on your favorite index. So the market did a full roundabout and came back up. Pretty impressive, and really kind of surprising if you think about it. What could have changed in that day that would have made investors feel comfortable that something's going to change for the positive when it comes to inflation or the Fed's reaction? So to no surprise, the next couple of days, the market sold off and rebalanced things out. But it was kind of a crazy day on the markets with the inflation reading. So let's go past that. So that is there. Let's go. Interest rates going up, hitting everywhere, as you know. Good thing is we're starting to see it hit in the savings rates. You're seeing online banks specifically having higher interest rates, seeing advertisements for CDs at 3.5% for 6 months or a year. Talk to your advisor of whether or not that makes sense to lock up your money and where you think inflation or where interest rates might be going in the future. But nonetheless, it's nice to see that some of our savings rates are going up. I mentioned online banks because typically they're going to have higher interest rates than your local bank or credit union, mainly because they don't have the banks, the branches, they don't have the staff. So therefore they have lower expenses, which means they can pay out higher interest rates. But eventually the physical banks are going to have to catch up as well. So that's the good. Now, it's not catching up to offset what the inflation rate is, but nonetheless, it's good to see the interest rates trickling down to us finally in higher savings. But where it's also trickling, as you know, is mortgage rates, and mortgage rates hit 6.92%. It's a 20-year high. Some banks are over 7%, which is obviously helping to slow down the housing market, at least the higher prices. You think about it, most people when they buy a house, they aren't necessarily buying the price of the house, they're buying the mortgage payment, meaning whatever they can afford at a payment they feel fits their budget is what they're going to buy. And with interest rates changing, nothing else, it's more expensive to buy the same house than it was a year ago, which means either people are going to not move up, or they're going to have to settle and buy a smaller house that costs less because now their payment is greater than it was just a year ago. A year ago we were looking at interest rates at 3.05%, and now we're at just about 7%. So definitely going to impact the housing market. Does it cause a crash? I don't think so. The problem with the housing market and why prices went up so much was that there wasn't enough supply for the demand. So supply problem still hasn't been fixed, but now demand is going down. So yes, you're seeing home prices go down. Real estate is typically, there's a trend across the country, but it's usually regional depending on what your area is. Some areas grew faster than others. They will be the ones that you might see fall harder than others as well. So noticing that that's going on. And then finally, a positive for retirees, specifically those taking Social Security. Social Security is slated to get an 8.7% increase, a cost of living adjustment next year. So they set that with inflation being as high as it is, it gives them a jump. Now, it's not as great as it sounds because this year they had a 14% increase in their Medicare B, which most people have come out of their Social Security. So the increase they got last year, I think, was maybe 6%, or this year, I think it was around 6%. Next year, it's 8%. It sounds great, but when you have Medicare go up 14 and your Social Security only goes up 16, it's not as great as it sounds. Next year, it says that Medicare Part B is supposed to go down, so that cost of living adjustment will feel a little bit better to retirees. So those retirees living off of Social Security, relying on that heavily, are going to see a nice bump up in their benefit, and the Medicare B should not go up as much as it did this year. So those are the main things I wanted to hit on. The other thing I want to end with is just my preference on thinking about this stuff. These are all things that we can't control. It doesn't mean that we shouldn't talk about them. It doesn't mean that it doesn't impact us, but there's not much we can do about inflation. There's not much we can do about the stock market in the moment. I've showed the chart before from JP Morgan's Guide to the Markets. I'll flash it up here again. What we're looking at when you strip out all of the narratives, all of the opinions, all of the headlines, all of the doom and gloom, the moves in the market this year are not abnormal. This is not the first time we've been down 20+%. It also does not mean that we have to finish here. I have no idea where the market ends the end of the year, but I like showing this chart so much because when you start to put narratives and you hear people making predictions and saying they should have done things differently and all these opinions that are out there, it definitely makes this year seem a lot scarier. But when you look at the numbers and you take away all of the narratives attached to every single year, if you go back over that chart, every year there's something going on. When you strip those out, this is normally what happens in the market. We do have years where we're down. It's not fun, but that's not abnormal. And that's why we're able to get higher than inflation rates over the long term, is risk and reward. So it's never fun when we go through these. You add on inflation and wars and elections and all these things going on, interest rates going up. Is the Fed going to get it right or wrong? Those are all stories that are explaining why this year is the way it is. But at the end of the day, there's always things going on that cause the markets to go up and down throughout the year. So what can we control? We can control our behavior. We can control what we consume, which feeds into our mind, which feeds into our mindset and our opinions. And we can also focus on finding the things that we're grateful in life. For most of us, what's going on in the market may not be a pleasant thing to experience, but it's not really changing our life over the next 20, 30 years. It's changing our thoughts about it in the short term, and maybe it's changing some things we have to do in this year or next year. But at the end of the day, it's probably not going to put most of us out of our house and home. It's not going to put us on the streets. It's not going to change the happiness that we have to be around our family. So not that we want to downplay totally what's going on, but don't let those things consume your life and you're spending all your time trying to figure out what's the Fed going to do, how do I navigate it. What history has shown us is that a diversified portfolio over the long run will take care of us for the most part. As long as we have good behaviors, we save, we live within our means, and all those types of things. So the final message for this week is just to focus on the things that we can focus. It doesn't mean turn a blind eye and pretend like nothing bad is happening right now, but don't let that consume you, and focus on the things you can control and make adjustments if you need to. With financial planning, there's nothing that says we can guarantee that you're never going to have to make an adjustment, or you might not be able to do something that you want to do. It's understanding our decisions and how they impact the long term. So focus on what you can control, and most importantly, just enjoy the life that you have, enjoy the family that you have, find the things that are good in your life and be grateful for that, and put out that positive energy and see what comes back to you in the long run. So with that, I'll let you get going. Thanks for joining me this week. Be sure to like and subscribe and all those great things. Share this if you found it beneficial and you think somebody else might like it. And with that, we'll see you on the next episode.